number of attendees that we have today, which is over 400. So thank you very much for joining. Needless to say, I think at the outset it's very important to express our sentiment of ensuring that you, your families, and your colleagues are keeping well and healthy during this time and situation that we are faced with. The agenda is really split into two parts today. The first part will be a panel session that I will moderate with our heads of financial services across the GCC. We have Mahesh from Bahrain, we have Bhavish from Kuwait, Ravi from Oman, Awais from Saudi Arabia, and Abbas from the UAE. And the second part of the session will be a Q&A, where we will take many of the questions that hopefully you will post through the chat box and discuss them and attempt to answer those questions. So what I'd like to do is maybe just to kick off with the only slide that we will be presenting for this session today. I can assure you we have no other slides, and it will purely be a conversation. And what I wanted to do is just start off on a positive note. If we look and compare back to 2008, 2008 really was a financial crisis. Where we sit today and the situation that we are faced with now really is a health pandemic that has emanated and evolved into a banking and economic and financial challenge that everyone is faced with today. So real distinction between what we saw in 2008. And really, as a result of that, the current situation brings about numerous additional challenges, uncertainties, and problems that everyone is dealing with. However, despite those specific challenges and uncertainties that we are faced with today, the reality is that there are numerous positives that have been coming over the last few weeks when we've been speaking to a number of our clients. And what we thought would be good was if we start with those positives, as opposed to just focusing on the challenges and the problems we're facing, really look to discuss and seek some of those solutions and some of the benefits that we've seen come through the last couple of weeks. So this slide that I'd just like to go through for a couple of minutes really sets out the 4 key points that we've heard from speaking to many of you today. And what I would just like to say at the outset is just to manage expectations, that we certainly do not claim to be sitting here today as panelists and leaders of financial services within our company, teaching or telling you something that you don't already know. I think a number of you and most of you know your businesses much better than we do. However, what we're really aiming to do is share our insights and thoughts from speaking to a number of banks across the region and bring those together and really share them with you in a collective manner. So really starting with the first positive, regulatory support. The regulatory support across the GCC over the last few weeks has been phenomenal. We've seen a proactive approach. We've seen regulators effectively communicate with the banking community and come out boldly with steps and measures that need to be taken. And in fact, the GCC countries were one of the first at a state level and at a central bank level to come out and address the need of the hour. And we saw billions of dollars in terms of stimulus packages announced. We saw numerous measures where the central banks have communicated with the banks to defer customer payments, to provide guarantees, and to waive off banking fees. And that was a really positive signal to the market, demonstrating really 2 things. One was the ability of these economies and these countries at a difficult time to be able to support what some would say is the engine of the economy. And the second point really is the willingness to be able to do that with such speed and effectiveness. So really the first point I wanted to address is the positive in terms of the regulatory support that we have seen in the GCC. The second point I wanted to touch upon was customer centricity. Now again, a customer focus is not something that's new. Customer focus, we've seen banks really having the customer at the top of their agenda for a number of years. In 2008, there were challenges in the global financial system. Trust, some would say, was broken, and there was a real disconnect between banks and the customer. Over the last few years, we've seen that trust develop, build again, and we've really seen a focus on the customer over the last few years. However, post this pandemic, what we've really seen is that focus has gone to a new level. I certainly see, as a customer myself, the number of messages and the amount of communication that I'm getting from my bank around how I should interact, how we should engage, what they are offering, absolutely increased over the last few weeks. Various channels, initiatives have been launched, whether it's paperless banking, whether it's cashless transactions, whether it's branchless interaction, and we've really seen customer at the very, very highest level on banks' agendas. And that can only be beneficial to the entire ecosystem at large, because ultimately the customer is what's driving many, many of the banking business models we see today. The third point that I'd like to point out in terms of positives that have come through over the last few weeks is digital innovation. Again, sounds very broad, sounds quite generic, but really there's some specific points on here that we want to address and start off with. Again, over the last few years, we've seen most banks within the region and globally, in fact, really look at developing the digital agenda. But what we have seen over the last few weeks is an acceleration of that. Over the last few weeks, we've seen banks accelerating, fast-tracking their digital plans. We've seen product launches and initiatives go to the highest level within banks and approvals being achieved much faster, whether it be home remittances for workers' salaries, or whether it be tap and pay, whether it be other innovative products. We've seen a number of new launches over the last few weeks, which is really demonstrating how banks have used this situation to fast track and accelerate their plans that they have been implementing over the last few years. And this is not just banks, this also involves numerous stakeholders. It involves the regulators, who've really been working overtime to approve a number of these plans and initiatives. It involves the shareholders in terms of managing their expectations. It involves the bank and boards in terms of acceptance and fast approvals. And ultimately, the customer is demanding this, and this has been the need of the hour and a significant benefit that we've seen over the last few weeks. And the fourth point and final point, and certainly from my perspective, the most important has been employee engagement. I'm speaking to banks across the region over the last few weeks. I've spoken to a number of people, and every single person I've spoken to has unanimously said that the levels of employee engagement, the levels of employee efficiency, and the levels of employee productivity have been the single biggest benefit they have seen in the last few weeks. We've seen greater engagement, we've seen greater communication across all levels within the bank, with boards and senior management interacting with staff at the lowest levels, which has been really, really pleasing to see. We've seen greater levels of empathy. We've seen bankers get to know each other, their families, their personal situations, and we've really seen those bonds develop further over the last few weeks, and that has certainly had a real positive in terms of the trust that's been developed and strengthened between employees and the employers. So really that was just a very high level summary, just to start off on a positive note on the four key themes that we have seen emerging over the last couple of weeks. What I'd like to do now is just move on to the panel session, and without further ado, if I could invite our panelists to join us virtually so we can start off the panel session. And as we can see today, just to mention again, we have Abbas from the UAE, we have Bhavish from Kuwait, Mahesh from Bahrain, Awais from Saudi Arabia, and Ravi from Oman. So if I could just dive into my first question, and maybe for you, Mahesh, from Bahrain. We focus now on some of the positives, and we've started on a positive sentiment in terms of this session. What I'd like to understand from you, Mahesh, is really over the past few weeks, interacting with a number of banks that you have, what have you seen, what have you heard in terms of the key challenges that banks are faced with today post COVID-19?
I think thanks, Omar. I think, as you said, what started off as a healthcare crisis has soon evolved or matured to a global financial crisis, pushing a lot of economies into recession. I think for the GCC region, if you add to that the low oil prices and the expected negative growth, it has created a lot more complex challenges that banks would have to deal with for a longer period of time. So if I focus on the key challenges that we have heard from our markets and witnessed over the last 2 months, I think when the crisis started unfolding in early March, I think the first challenge banks dealt with was around liquidity pressures. I think while the local currency mismatches were well managed through regulatory action and a lot of lines being provided, there was a shortage of US dollar funding. This was not only for the region, but it was also a global phenomenon. And we have seen a visible increase in US dollar funding spreads over the short term. I think with the added pressure on sovereign ratings in the region because of the low oil prices, I think what we've seen is also that the repo markets have started, providing very low LTVs for sovereign issues for US dollar funding. So that is something that is a challenge in short-term banks are still dealing with. If I move on to the next challenge that we immediately witnessed was the concerns around revenue compression. I think the banking industry this time around has stepped forward in a significant way to support the economy and its customers with the 6-month payment holiday program. And in most cases in the region, this was without any additional interest. What this effectively meant was, banks are going to face significant pressure on revenue compression this time around. And if we add to that the overall low interest rate environment and the highly insulated economic support agenda in the region, I think it's going to be a big challenge for banks to try and increase their lending rates to offset this compression. I think the next kind of challenge or concern with most bankers would be faced with is credit quality. I think this is always a significant concern and a fallout of every financial crisis. With the extended lockout periods and restrictions being imposed, I think businesses that operate with low survival horizons or sustainable operating models in these times would definitely, fail. To top that, concerns around the real estate sector prices and looming job losses, I think will eventually reflect on the banking sector. But the real difference this time around is the trajectory of losses is expected to be steeper because we are now in the IFRS 9 world where everybody is required to take expected credit losses, which are more forward-looking. We have probably seen a sense of that in the Q1 results announced by global banks and also some of the banks in the region as well. Thanks so much.
Thank you for that comprehensive response, Mahesh. So I'm really hearing liquidity, revenue compression, and credit as the key challenges. What I'd like to do is maybe just bring in Abbas from the UAE just to see if there are anything other comments for you to.
Sure. No, thanks, Omar. Look, I completely agree with Mahesh. Liquidity pressure, revenue compression, and credit quality are definitely 3 of the top ones. I'd probably add a couple more to it. I think operational risk, and I'll briefly talk about digital acceptance as well, because I think that for me is quite important. So operational risk has been an area that banks globally have been playing catch up on. I think there's no two ways about it. And with the new norms that we have been talking about for employees and customer engagement, a whole new set of operational risks have to be considered now. Just last week, I was reading Info Security reported in April approximately 40% increase in cyber attacks over the last month. Now, this is expected, right? Considering more than 80–85% of the workforce is actually accessing systems remotely. I'm not at all surprised, and this is what the new norm is expected to be, based on all discussions, conversations that we are having. We will indeed see an increase in cyber risk, fraud risk, increased anti-money laundering threats to the banking system. With the new products and significant amount of automation, I think banks will need to deal with the new normal with a comprehensive operational risk management framework. I think my next one was digital acceptance. Look, the region has traditionally operated under a personalized banking model. While banks have been pushing for more customers to get into the digital channels, the sudden shift in that becoming a primary channel will still require careful and well-planned engagement with customers. I think that is something that the banks have embarked on, and it has been accelerated, but that is very, very important going forward. Having said that, I think the current situation will also force customers to explore the digital channels more. With that, over to you, Omar.
Thank you, Abbas. So really adding to what Mahesh has said around liquidity, credit enhancement, and also revenue compression, I think operational aspects and the digital points you mentioned are very valid. And on the cyber point, just to add, I think certainly I can vouch for that as a customer at the moment. The number of spam emails, phishing emails that we've had over the last couple of weeks has been phenomenal. So thank you for that, Abbas. If I could at this point just shift to a poll question, our first poll question of the 5, if we may. It would be good just to get everyone's thoughts on this. So the first question that we have: what would you consider to be your most pressing immediate challenge post-COVID 2019? And this does probably seem like a tricky question in that all three are probably very relevant and challenges that you faced. But I think what we're really looking to get an answer for is really what was your most pressing and immediate challenge? We have the 45 seconds for everyone to respond. Just waiting for the answer to come up now. 40% of you say liquidity was the most immediate and pressing concern, followed by 32% in credit. And actually, that doesn't come as a surprise from speaking to most of our clients over the last couple of weeks. The most immediate challenge that we were hearing was actually liquidity. Post then, we have had 4 state-level bond debt issuances over the last few weeks, and that certainly has alleviated some of those challenges. And speaking to bankers in the last few days, the view is that some of the liquidity concerns at the immediate outset have certainly been alleviated in recent days and recent weeks. So certainly not a surprise with that response. So thank you, everyone. So if we may move on to the next panel question. At this point, I'd like to just bring in maybe Bhavish from Kuwait, if possible. And Bhavish, we've talked about some of the positives that I covered. Mahesh discussed some of the challenges that banks are facing. It'd be good to get your perspective, just to see really what you're hearing from bankers in terms of what are they actually focused on at the moment.
Good afternoon, everyone, and thanks, Omar. As we start speaking to banks in Kuwait and the region, we're seeing that banks are having to step up to support the local economies and be part of the growth engine once the lockdowns start easing. In doing so, we have seen common themes and areas of focus, and the first amongst them is cost optimization. As Mahesh rightly pointed out, in a low interest environment, in a scenario where you have deferral of repayments and loss of additional interest in certain circumstances, banks are feeling the pressure on revenue. As such, banks are having to look at an accelerated pace on their costs. And what we are seeing is that discretionary spending that does not contribute to the core banking capability, core banking capabilities are being slashed significantly this year. And we expect this trend to continue into 2021 as well. Another area of focus, which is not going to be uncommon, is going to be human resources rationalization, where areas of the bank that are going to see deep decline in revenue are going to really having staff being laid off, and that's going to happen pretty quick, is what we see. Another area, or the second area of focus, is building resilience. This crisis has brought working from home. It has brought working remotely, more digital innovation, as you pointed out, Omar, to be the new normal. As such, and even as pointed out by Abbas, this is causing the rise of an emergence of new operational risk framework, operational risks rather. So all this is resulting in banks having to focus on building additional resilience in their operational risk framework and cybersecurity frameworks to ensure that there's going to be minimal disruption to the business. And as Abbas rightly pointed, banks are going to get hacked. So how do they then build the additional resilience into their networks to ensure that any attack is going to cause either minimal to no disruption? The third common area of focus, what we are seeing is really scenario planning. So far banks have had to consider policy statements by regulators and macroeconomic conditions in their scenario analysis. An additional element that is now coming through because of the crisis is health and safety guidelines, where you don't have people being able to work that they have. This coupled with the fact that the guidance from regulators, macroeconomic scenarios are changing so rapidly, banks are almost having to simulate in real time the impact of all these changes on their capital, liquidity, and provisions. Yeah. Thanks so much.
Thank you very much for that, Bhavesh. So just to summarize again, cost optimization, building resilience, and scenario planning. And if I were to pick out one, really around the operational resilience point, certainly from speaking to bankers over the last few weeks, that really seems to be a common theme and a real key focus area, because that seems to be a differentiator when compared to challenges that banks have been faced with in the past. But I would just add to that, just to say over the last few years, what I am hearing from bankers is that they do seem to have been, so to speak, acclimatized with some of the challenges that have been faced in the region politically and economically. Bankers do feel that they are in a much stronger position to deal with the current situation, given what they have faced in the past. So thank you very much for those thoughts, Bhavesh. If I could maybe just reach out to Awais from Saudi, just to see if there's anything to add from your perspective, Awais.
Thank you, Umar. No, I'll build on what Bhavesh has mentioned about Kuwait. I think for last 2 months, the themes in GCC are very much consistent with the global themes, whereby people have moved from the asset growth model towards asset protection model. And of course, cautious credit underwriting. On the other side, of course, the sentiments are more towards customer retention, as well as continued stakeholders communication. This is extremely important in turbulent times, that you remain engaged with the regulators, with your shareholders, as well as your other stakeholders within the organization and outside. In Saudi, we did a survey with our large banks a month ago, right in the middle of the COVID situation, and we asked what are the common themes evolving, especially to the country. And by and large, the overarching feedback we got was that banks are looking for a future that is more interconnected, collaborative, and frictionless. These are unprecedented times, and therefore they are trying to struggle at the beginning. But having said that, there are a couple of operational and product level insights that we received. So of course, the credit portfolio is on a triage, whereby most of the people are looking at it from the perspective of identifying the potential high-risk customers and coming up with the bespoke remedial measures. But also there's a segment which is evolving as a new customer model or alliances between two different customers or segments, whereby there's an opportunity of nurturing them at the right pricing and give them sustainability in those areas. So COVID has definitely brought new customer segments to the industry, which have worked really well in this lockdown situation. On the specific product level, of course, if you look at the first 2 months results when the lockdown was not triggered, mortgage finance was by far the fastest growing commodity or the product within Saudi. Mainly because of demographic nature and the population. Of course, it has been very successful. The private sector, of course, is the second area which remains to be focused for the banks. So I would say on an overall basis, there is a sentiment of cautious optimism. So people are not only concerned about protect their losses, but also seeing the opportunities as well for growth in the current scenario.
Good. Thank you for that, Awais. So I'm hearing opportunity despite times of adversity, and cautious optimism. So thank you for that. If we could just move on to the next poll question, our second of the five, and really just moving on from the theme that we've just discussed around focus areas and liquidity being a challenge. The next question is, do you expect banks to tap debt markets and capitalize on the low interest rate environment post the lockdown? A, yes in 2020, B, yes in 2021, or C, no?
Omar, I would like to say 2021, when people have the banks have seen what post-lockdown looks like, a much more stabilization of the interest rates, and ability to really see what the scenarios are. So I would really think 2021, but it will be very interesting to see what our participants say, whether they believe it's 2020 or 2021. So let's wait.
I like that, Bhavish, being bold. So let's see. And you're absolutely right. 54% have said 2021. So being bold paid off, Bhavish. So well done. But just to add, I think it's very consistent with what we're hearing. The general view from what we're hearing about is really 2021. There's a lot of uncertainty. Not sure when the lockdown will end. Yes, interest rates are low. Banks are looking at bilateral transactions and arrangements in terms of raising funding, in addition to government and state level support, but really 2021 is when most feel confident about going back to the debt market. So interesting responses there. Thank you all. So if I could move to the next panel question, if that's okay, and maybe just bring in Ravi from Oman. And Ravi, we've heard about the positives, we've heard the challenges and the focus areas, and we've touched briefly upon opportunities, but really be interested in getting your views around where you see the real opportunities arising from the current.
Thank you, Omar. Well, in terms of opportunities, I guess where there is a challenge, there are opportunities. And in addition to whatever Awais has already briefly touched upon, I'd like to pick up three key themes that I've seen based on my conversations with some of the banks. And the first one among them is the digital expansion. As you have alluded to in your initial slide, we've seen that banks are pretty focused on their digital strategy for quite some time, but the current market conditions is just conducive for them to really go on a fast track as far as their digital offering is concerned. I think given their digital transformation journey, banks were expecting few products to be launched, let's say 3 years down the line, but the current market conditions are conducive for them to sort of fast track it and probably launch it in next 1.5 years. Regulators are showing flexibility. Customers' acceptance seems to have gone up as far as accepting these additional digital products is concerned as well. So I think that is where I see a significant opportunity for some of the regional banks to go ahead and tap those opportunities. The second one I had in mind was, and this is something that is complementing to the digital offering that I've just talked about, is the branch rationalization. I think some of the large banks does have a pretty large branch network, and it does represent a significant fixed cost to some of the banking organizations. Given the digital offering agenda that most of them are pursuing, we see opportunities for them to really look at their branch network strategy and see where they can rationalize and reduce some of the fixed costs that they're incurring on account of these branches. Again, having said that, I appreciate that this is going to be challenging because majority of the fixed cost represents staff cost, and it's not going to be easy to tap this opportunity, but there's definitely opportunities in that particular aspect. And the third and the final one that I want to talk about is the consolidation in the sector. We do see that while some of the banks have always been looking out and expanding in terms of acquisitions, etc., since the financial crisis, I think the current market conditions again gives them ample opportunities to actually grow inorganically and go and identify targets and see if they can expand through consolidation.
Thank you for that, Ravi. So really, digital expansion, branch rationalization, and opportunities for consolidation. And we have seen over the last few years a wave of consolidation within the region. But hearing and listening to you, I think the view is there are opportunities to see further consolidation in the sector across the region. So all I would do is maybe just add one more, if I may, and something that we've been hearing from bankers over the last few years, but really accelerating those in more recent weeks, just as around balance sheet optimization. We really see an opportunity in banks looking at efficiencies of their balance sheets, looking at their core assets, seeing that there is a flight to quality and a flight to maintain high quality assets. A lot of bankers actually in recent times and going forward can ensure that they do a real deep dive and thorough review of their balance sheets, see which assets, and particularly on the non-performing side, can be sold, which assets can be swapped. And I think that's certainly an area of an opportunity for banks to use the current situation to really do a complete overhaul and review of their balance sheets as they stand today. So that was just to what you had said there, Ravi. So thank you very much for that. If we could just move to our next poll question, the third poll question. I'm really, again, on a similar theme around focus areas, but really just trying to pin this down. And the question is, what do you believe is the priority out of the following over the next 12 months? A, revenue enhancement, B, cost control, or C, digital investment? And again, all three are probably very valid, but it's really the single priority that you have and over the next 12-month time horizon.
Or I think most of them will probably go for the cost control. Although I think digital investment over the next 12 months and longer could be an interesting option as well. So really interested in seeing as to what everyone has to say on this.
Sure, thank you for that, Ravi. The 45 seconds is up, so cost control, you are right once again. And I can assure everyone this hasn't been pre-planned. This is really you responding. But as Ravi said, cost control is likely to be the focus over the next 12 months, and 51% of you are saying that cost control is actually the focus area, followed by digital investment, and then third is revenue enhancement. And that's again consistent with what we are hearing. So thank you everyone for responding. If we could move back to the panel questions, if that's okay. Next question I have is for Awais from Saudi. So Awais, if we look back to 2019, and the banking results are all out for 2019, we saw double-digit growth. We saw 13% growth in assets across the GCC listed banks. We saw 17% growth in profitability. We see ROE at north of 10%. Really looking to get your views on, A, do you think those double-digit growth trends will continue in the short term? And if not, when do you think we will return within the region to those double-digit growth rates we've seen in recent times? Always.
Thank you, Umar. This is very interesting, actually. Yes, when we were issuing our banking perspective, you will talk about the GC report as well in a while. This has been a double-digit growth year for the industry. I'm very optimistic that this double-digit growth will come. I hope I had this view on the timing as well. Now. But I must say that the times of stress are also signals for the growth. Time and again, we have seen the GCC to be slightly different than the global markets because of multiple factors that I'll probably like to add here as well. Be it 2008 credit crisis or the significant volatility in the oil prices in 2017 and 18. I think the banks had the ability to come out of this in months and not years. And I would say that that's fundamentally because of their domestic focus. If you look at it, the global players or the investments in those capital markets on an overall basis is quite relatively low in the GCC sector. If you look at the main fundamentals that have helped the banks to come out of this, of course, the low cost of deposit. If you look at it, the Sharia-based financing, which in Saudi specifically is giving almost 76 to 80% spread to the banks, that give them the hefty muscle to deal with the situation. On the other side, it's widespread towards GCC as well. Now, on the other side, of course, the regulators, they should get a credit that they closely monitor the money supply in these times. And we do look at the 103 from the SAMA perspective, not much volatility we have seen so far, which is also a good sign. Third foundation, which protects, is of course the government measures and close assistance as well. You mentioned earlier about the stimulus program. I think we shouldn't only highlight that how large they are, but how quickly governments have come and tried to help the industry. I can speak about Saudi. I mean, the money started flowing into the banks within 2 weeks' time, of the lockdown. So that's quite fabulous. So building on that, I would say that these factors have helped the banks to come out. I mentioned about the favorable demographics, which is more about the mortgage finance and SME sector. That will continue to give banks a chance to grow. I would like to highlight on the polling question. I think the first one, whereby people looked at the liquidity as a challenge, but not the capital. That also tells us that banks are sitting on a strong balance sheet and capitals, and therefore the impact can easily be absorbed. There would be, of course, some challenging times in the short term when industry is trying to assess the portfolios and of course assess the impact. But and of course, I'm sure you would be aware about the recent austerity measures on cost of living allowance and increase in VAT, but that's more domestic. But on an overall basis, I believe that it's only a short-term phase, and banks have the agility and the financial stability to come out of this crisis pretty soon.
Thank you for that, Wais. Continued optimism. And just to add to your point on capital, I think if we look back to 2019 at the year end, the average CAR, the capital adequacy ratio for GCC listed banks, was 18.5%. And I read a report just yesterday morning saying that, from a rating agency, in fact, saying that banks in the region could absorb up to 3 times the level of credit losses they have at the moment before they start eating into those capital buffers. So certainly just echo your sentiment there. Maybe just reaching out to Bhavesh, just to see if you share the same optimism as a...
Yeah, I mean, Omar, certainly building on what Wais has said, speaking to the banks in Kuwait, there's a realization that it's going to be some time before the days of double-digit growth are back. In Kuwait, the central bank has lowered or slashed the discount rate to a historic low of 150 basis points in March. And this is on the back of the US Federal Reserve cuts in March as well. This low interest rate environment is going to put a significant pressure on the net interest margin income of net interest margin of the banks. So I think, given that this low interest environment is going to expect it to continue for some time, I think banks will have to start finding new ways to make money and certainly make their operating model more agile and leaner to be able to cope up with this new normal. Thanks.
So cautiously optimistic then, Bhavesh, I'm hearing from what you said. So if we could just move to the next poll question, 4th out of our 5 poll questions. And again, moving from what we've just discussed, is really seeing how do you expect your business models to develop post-COVID-19? You see A, a rapid transformation, or B, a gradual evolution of pre-existing plans?
I think this is very interesting and relevant for current times. And probably if you look back for last 2 months, I would only go with one option. And let me just park that. I don't want to influence people, but I think we have seen unprecedented move in terms of transformation in last two months. But let's see how our participants believe about it.
Thanks, Awais. I like your confidence, Awais, thinking that you can actually influence a group of 400 bankers. But I'd be interested to know what your view was. So fairly even actually, but people are saying 49%, almost half are saying a rapid transformation. So was that your view? I would like to know.
Yeah, definitely. I've seen a major shift. people are taking it to a rapid transformation rather than gradual evolution, because you can't be slow when your competitor is trying to leverage, because you will lose your market share, and not only to address your crisis, but about the growth opportunities as well. I think I had this view of A being the option. But it's good to see a fairly neutral number of people coming on the gradual evaluation as well.
Good, thank you for that, Awais. Just moving on to the next panel question, if I could bring in Abbas from the UAE. We've talked a lot about digital, Abbas. We've talked about acceptance, expansion, fast tracking of plans. Really just good to get your views. A very bold question, but how do you think the GCC banks compare to their peers outside the region when it comes to digital offering?
Sure. Thanks, Omar, for the question. Look, I think I'll start by saying that in my mind, the bank of the future is very different from what it is today. Now, we've talked about rapid transformation or gradual evolution. I think at some stage we will get there, because the bank of the future is not what we see as banks operating today. We've talked about the digital acceptance as challenge earlier, but I think banks and other financial institutions are faced with tough times ahead, and technology here can help mitigate this. Banks have effectively leveraged some of the digital assets, and the ones who do that effectively are going to reap the benefits. So some of my friends, colleagues attending this webinar might not, or some might accept, or some might not like my answer, but I think just to address the question directly, where do I see GCC banks stand versus their peers? I think the players in GCC states are ranked below some of the developed Asia players, right? I think European banks are slightly different, but if I compare where we want to be is where some of the developed Asia banks are. There is some urgency to step up the pace. We will also see competition from digital-only banks, and a number of fintech startups heat up as things develop, and we've seen that happen in the developed markets over the next, and we'll see more of that happening over the next 3 to 5 years. Nevertheless, I think many regional banks offer sophisticated banking apps and online services. However, let me be very clear. I think bank branches will not disappear from the GCC in the short term, at least. Despite all the digital offers, we do believe that physical channels will continue to play a major role. However, banks will need to repurpose their branches. I mean, I think they'll focus more on higher value advisory services rather than your box standard branch services, which happen at the moment. Challenger banking services are also on the rise. We've seen several established banks here in the GCC setting up digital banks, digital arms, including SME-focused digital bank offerings. But let's face it, I think more needs to happen. And with the poll question earlier, I think we do see a rapid transformation around this over the next year or two. So to capture the digital opportunity, I think they must acquire and nurture digital talent that fosters creativity, flexibility, and speed. And I think very important is the building a digital marketing capabilities that equal those of e-commerce players. I think another very important aspect is the logic of banking ecosystem. This integration of services will be fundamental for digital banking in years to come. It's primarily expanding your offerings beyond traditional core banking services. And the focus is on helping customers, consumers, simplify their daily lives without even leaving the bank's portal. I mean, take WeChat, for example, which enables users to send messages, make payments, invest, order taxis, buy bus tickets. I can go on, just from a single integrated system. Today, customer experience expectations are set by non-financial organizations. The likes, and these are daily, we all use them, right? The likes of Google's, Amazon's, Facebook's, Apple's, and so on. There should be no need to visit different platforms. That's my fundamental view, and that's where banking will head in the future. The market could move from a product push sales mentality to a proactive one that encourages needs-driven solution offering. I think with that, back to you, Omar.
Thank you for that, Abbas. So what I'm hearing, really, there is certainly a gap in the marketplace. And with people actually looking at banks looking at rapid transformation, we could see that gap being filled with some of the innovative approaches that you've just discussed. So So thank you. What I would like to do is maybe just call upon Mahesh from Bahrain. I know in Bahrain, they often consider themselves to be pioneers and leaders when it comes to fintech and have been the first movers in this space over the last few years. Just good to get your brief thoughts, Mahesh, on anything just to.
Thanks, Omar. I think adding to what just Abbas summarized, I think digital maturity in any region is driven by customers' preferences and the volumes the platform will actually process. I think what we've heard or seen over the last 2 months is that there's been more than 50% growth in the transition to digital platforms as compared to the traditional ones, purely because of the restrictions the crisis imposed. So I think this is really going to accelerate all the digital and fintech programs and maturity within the banking sector in a big way. I think also most of the digital strategies were focused more on retail. I think there was a clear, visible need to try and focus on corporate and trade finance-based solutions, which will also, I think, get accelerated. So in my view, I think our banks are midway in their digital journey, but the speed of catch-up will be very fast given the crisis has actually kind of given that as a nudge. I think also for a catalyst for digital environment or ecosystem is also regulations. I think now I would expect significant or faster changes in regulations in the region in the short term that would support faster acceleration of digital and fintech solutions in the region as well. Thank you.
Thank you for that, Mahesh. If we could just move to the last poll question before we do move on to addressing some of the questions, and I see there are a number of questions that you have posed. So when do you expect to see the true impact of COVID-19 on the GCC banking sector? I think it seems to be the million-dollar question, but it'd be good to get your thoughts.
Omar, I think this is a golden question which everybody has been asking me within the banking sector. If I knew the answer to this, I don't think I'll be sitting here in the webinar talking to people making a lot of money. But I think from my perspective, we'll see an impact coming in 2020, but more to come in 2021 when some of these stimulus packages go away. But interesting to see what people think.
Thank you for that, Abbas. We've just got a few seconds left. So far, I think we have been right in most of our predictions, but I don't think there's a right or wrong answer. I guess everyone will have different views, but it'd be interesting to see what people come back with. As you rightly say, 2020, so 51% really believe that 2021 is when we'll see the true impact, and 26% of you believe that 2020 is when we'll be seeing the real impact. So time will tell, and we shall see. So thank you everyone for responding to that question. I'm very conscious of time. If we could just move on to address some of the questions that I've seen being posted. So at this stage, I may just go off video and just to read some of the questions and pose them to our panel. So the first question I can see here, maybe just for you, Mahesh, and not to put you on the spot, do you expect to see more consolidation in the banking sector across the region?
I think this is probably a point that has been discussed on and off during the crisis. I think Ravi also alluded to that in his cover. I think there are mixed views on this topic. We all know that the region has always historically been seen as an overbanked region, and we have our share of smaller banks who actually operate below expected banking sector benchmarks. In our region, especially, I think consolidation in the banking sector requires two stakeholders to come together. You have the board and shareholders in one part, and you have the regulators who play a critical role in consolidation. So I think every financial crisis reinforces the point that only the large and well-diversified banks could weather the storm. And in an overbanked market, only the agile would probably survive in the longer run. I think with all this talk and huge investments in digital banks, I think all these investments would eventually see scales and volumes. So from an opportunity standpoint to expand the regional footprint and consolidate market share, I think this may be an opportune time for banks, who are strong in liquidity and capital. However, if I put myself in the shoes of a regulator, I'm unsure how they would respond, because at the time of a crisis, you tend to take a very inward view. You would want to kind of protect the local market and not necessarily increase your cross-border risks that would transfer resources out of the country. So I think there might be some conflict between consolidation view from a board shareholder perspective and what a regulator would support in these markets. But that being said, I would expect a lot more M&A activities in the banking sector, where we would look at banks trying to acquire a lot of fintech service providers. You have a lot of open API-based solutions and aggregators also coming through. And this would emerge from the various regulatory sandbox projects that were introduced by the most GCC countries to accelerate the fintech adoption. And I think banks would see that as a logical M&A target to integrate and accelerate their future. Thanks.
Thanks, Mahesh. Number of questions here seem to be around the impact that the current oil prices will have on the growth forecast for GCC banks. So, Bhavesh, good to get your brief thoughts on.
Yeah, thanks, Omar. That's a very interesting question. As most of us are aware, the GCC economies are primarily oil-driven. For example, in Kuwait, oil contributes more than 90% to the government revenue and the exports, and over half to the GDP of the country. As such, if government spending slows down, we will witness banks having to lend less and then having to not see the growth that they are used to. That said, and following on from what Mahesh was saying about larger banks being able to weather the storm better, what we will see is that it's the smaller banks who may find it difficult to lend, either on account of liquidity or having to take a lot of provisions for the credit that they have on books. And the larger banks with large capital bases, comfortable capital adequacy positions, would be able to really lend and step up. So we'll probably see, a parallel tracks of smaller banks not being able to grow and struggling, whereas the larger banks growing a bit slowly as compared to what the previous years have shown. So I think two tracks there.
Thank you, Bhavesh. There are a number of questions here, and unfortunately, I don't think we'll be able to get through all of them, so I may skip a few. There are a number around the accounting rules, in fact. Given that we do have a group of accountants, I think what I'd like to do, maybe just bring in Abbas actually at this point. And one of the questions is around, do we think the accounting rules over provisions will be amended as a result of this crisis? So a very topical question, I know, but your thoughts, please.
Sure. Thanks, Omar. You know what? This is a question I've had from number of banks over the last 8 weeks or so since we faced this issue. Look, I mean, when IAS 39, going back a bit, when IAS 39 was introduced in 2005, there were issues with that. Subsequent to that, IFRS 9 came in as a game changer, which was introduced by the IASB as a response to the financial crisis, specifically aiming at improving accounting and reporting of financial assets and liabilities. Now there's another crisis and you again start asking the same question. I think my view is you could not have one set of rules for boom times and one set of rules for bust times. I think standards need to be consistently applied. But having said that, I'm quite encouraged by how the regulators have stepped in, not just regionally, but even globally, in helping providing guidelines and clarifications on how some of these things should be applied and sort of IFRS 9 rules should be interpreted, right? So there have been a number of guidance and clarifications issued by regulators, and I'm encouraged that they've stepped in. Look, this pandemic is different from the global financial crisis in 2008 because banks have to play a very important and a significant role in supporting the economy now. Previously, it was different. Now it's slightly different. And hence, it would not be too unreasonable to ask for I know coming from an accounting sounds a bit, ask for a pragmatic application of current rules. But Umar, to answer your question directly, we don't expect any wholesale changes to accounting rules anytime.
Good, thank you for that, Abbas. I do like bold answers, so I'm glad you did answer the question directly at the end. So look, I'm very conscious of time. As I said, there are a number of other questions. We will collate them. We will look to see if we can come back to everyone with responses to those. But what I would like to do just before I do close is maybe just run around the table, the virtual table, so to speak, and just get some real closing thoughts. Max, guys, please, 2 to 3 words, just with your closing thoughts to leave our audience with. So if I could just start off with Mahesh.
I think stronger and resilient banks after the crisis.
So Bhavesh?
Omar, you asked for 3 words.
Omar, you asked for 3 words.
I think those are consolidate, consolidate.
Okay. Ravi?
I think digitally focused.
Great. Awais?
I would go with cautious optimism. I mentioned in my
Cautious optimism. Good. Thank you. And Abbas, finally yourself.
I think for me, it's banking the ecosystem and the most important planet.
Great. And I think I should also try and answer that question. From my perspective, it's about trust and culture. So thank you very much to our panelists today. I'd like to take the opportunity to thank everyone for joining us. I think we had over 400 people join this webinar today. So thank you. We will look to do more in the future. Please do share your feedback at the end of the session. And just a couple of notes just to close it. We will be sharing our GCC banking report with you all, our annual publication in the next few days, which will really look back at the 2019 results. And hopefully that will be interesting for you all. I think the 2008 crisis, banks were really deemed to be the villains. Trust was lost. There were a lot of challenges around how banks are dealing with the customer. Certainly from our perspective, now in 2020, banks really have the opportunity to move from being the villains to being the heroes. This is not the first nor the last financial crisis that any of us will see. I still clearly remember 2008, and now we're in 2020. As a result of the current situation that we're faced with, banks will come out more efficient, they'll come out leaner, stronger, and most importantly, more innovative. So thank you very much once again. Eid Mubarak in advance, and please do stay safe and well, and we look forward to seeing you all again very soon. Thank you.
Thank you all, and Eid Mubarak to everybody. Stay safe. Thank you.
Thanks a lot.
Thank you.
Everyone. Eid Mubarak.
everyone.